Assalamu alaikum friends, how are you doing? So I thought of coming with the strategic business reporting revision for September. I will be doing revision for all the IFRS and IAS standard, current issues, ratios, and ethics and conceptual framework as well. Because the reason I thought that since I have done the revision series for advanced audit and assurance I'm currently doing, and I have completed for AFM, I thought why not do it for SBR, right? And my lectures and my revision kit solutions on SBR are there on the playlist. You can get it. I haven't completed the revision kit questions. I was unable to do it, so I'm so sorry for it for the September exam. But whatever I have done will be enough for you to cover the important things, right? Whatever I have left incomplete, inshallah, I will be doing it for the September exam. Okay, so I thought, but in my revision series, I'll be covering all the current issues, everything, whatever I have left incomplete in my lecture. Right, lecture almost I've completed, but revision kit solution I was not able to complete. So that's why whatever I've completed is there now. I've updated it. It's there on the playlist. Okay, SBR revision kit solutions. So there'll be a separate playlist for the revision series. And this revision series can be used until June 2022. Yes. So September, December, March, and June. 4 sessions you can use this revision series for SBR. So our first topic is conceptual framework in financial reporting. Okay, very important topic for your SBR exam. And the good thing is you will be able to match because even my lectures are also numbered in this way. They're in this order only according to the standard, starting from conceptual framework, ethics, and then starting from IAS 1, 2, like that. It's ordered. So in my revision series, it will be ordered in that way. Okay, and the good thing is it's very small. It's not time consuming. It's not for hours and hours. Maybe some videos maybe I can finish in 5 minutes or 10 minutes. Within 10 minutes I will be able to finish the revision series. Okay, so let's start with conceptual framework in financial reporting. These are the things you should know for conceptual framework. What is the purpose? What is the purpose of the financial reporting? What are the qualitative characteristics, the elements, recognition, derecognition, measurement, presentation, and disclosure? If you know this areas 1, 2, 3, 4, 5, 6, 7, 8, this 8 areas of conceptual framework, you don't need anything else to pass. Regarding conceptual framework, you will have a good understanding of conceptual framework. You don't need to go through your textbook also because everything is covered here. It is summarized and it's covered. This you can even use in your answers also. But definitely that does not mean that you have to write in bullet points or short sentences. You have to make up your own sentences. But the points are here. The points that you have to take. Okay. But that does not mean that you don't have to revision kit questions and past paper questions and just you can rely on this videos revision kit. No, this is just a revision, just last minute. We are summarizing everything together. So let's start with the purpose of conceptual framework. There are three purposes of conceptual framework, three main purposes. Number one, the main reason why conceptual framework is there is to assist, that means to help the board when developing new IFRS standard. Okay, whenever the board develops any new standard that you see IFRS 1, 2, 3, whatever standard you are saying, it is based on the help of conceptual framework only. How they have defined asset, liability, income, expenses, equity. Second, prepares the financial statements. This will help the one who's preparing the financial statement also, the conceptual framework. When no IFRS standard is there, okay? Or when IFRS standard allows a choice of accounting policy. In these two conditions, conceptual framework will come into the picture and help you. Number three purpose. All parties when understanding and interpreting IFRS standards. It helps all the parties in order to understand it as well as to interpret the IFRS standard. So remembering these three purposes is enough. What is the purpose of the financial reporting? It is to provide useful information to different stakeholders. For example, current and potential investors, lenders, creditors, so that they can make an economic decision. Okay, that's the sole purpose. Next, user groups need information to assess few things. User groups means the stakeholders. Why do they need information? One, to see the potential of the entities, future cash flow. Second, management stewardship. How well the managers have utilize the resources or use their resources that they have been entrusted by the shareholders, because we know that shareholders does not come and manage the company. They don't run. Yes, they might be shareholders, they have shares in the company, but they don't run it. It's the management's duty. They run it on behalf of the shareholder. So looking at the information, you should be able to tell whether managers are performing their work or not, and also the entity's future cash flow. Definitely your future cash flow should increase. Okay, that's the whole purpose, which is a good sign, but it does not happen. So you need information to assess this, whether it will increase, decrease, what happens. So these are the two reasons why information is needed. Then this information is provided in the financial statement. Okay, that's why we need financial reporting, to see how the managers are doing their job as well as the potential of the future cash flow of the entity. And all these are provided there in the financial statement. Now, qualitative characteristics. There are two qualitative characteristics. Qualitative characteristics are divided into two categories. One is known as fundamental characteristics. This has to be there no matter what. First, you have to pass through this, whether it has the fundamental characteristics or not. Qualitative characteristics means for the information. What makes an information useful? Having these characteristics. So for fund, and the second category is enhancing, which makes it the financial information more useful. But remember, if we have the enhancing characteristics but not the fundamental characteristics, no. You should first have the fundamental characteristics. After that, you have to check whether you have the four enhancing characteristics or not. It makes it even better. So, the qualitative characteristics of useful financial information are two. Fundamental. Under fundamental characteristics, we have relevance and faithful representation. Faithful representation. You can remember this as FR. Faithful representation and relevance. Any information that you are putting in your statement of financial position or statement of profit or loss or cash flow or statement of changes in equity or in your disclosure, number one, it has to be of relevant. Number two, it has to faithfully represent the transaction. Coming to the enhancing characteristics, there are four enhancing characteristics. Number one, verifiability. Your information should be able to be verified. Number two, timeliness. It should be provided in the timely order. Okay. For example, you are giving some information which is 1 month with a 1 month delay. It's not useful now because the situation changes, circumstances have changed. Okay, so you have to provide that information in the time that it is required. Timeliness. Number three, understandability. You should avoid technical jargons and all. It should be understood by everyone because there are so many stakeholders who are going to read that report, not only one category of people. So keeping that in mind, it have to be understood. For example, you are calculating the depreciation of non-current asset. You may be using some policy, right? It has to be understood by everyone. Then comparability. You should be able to compare with the previous year, with different entity in the same industry, right? So this four. Now let us go to the elements. So these are the elements in the conceptual framework. Asset, liability, equity, income, expenses, the five. And you should know the definition. And these definitions are only used in the IFRS. So for asset, it has to be, that means you are controlling a resource as a result of the past event. That means something you have done in the past. That's why you're having the control of that asset. In the past, you have bought that asset. You paid in cash and you bought the asset. You are controlling. As far as you are controlling, that means it's an asset. But the control should pass to you. If the control didn't pass to you, it's not yet an asset. The second one, liability. Present obligation. That means you have an obligation to pay. Right, to transfer an economic resource as a result of past. This is also because of the past event. Maybe in the past you have taken a loan from a bank. Now you have the obligation to pay that loan to the bank. Something must have been done in the past, right? That's why you have to pay. You have that obligation. Equity. Equity is after you deduct your liabilities from asset, whatever is left over is known as equity. Simply the net asset. Then coming to income. Income is whatever increases your asset or decreases your liability. Okay. And expenses is the other way around, opposite of income. Decrease in assets or increase in liability. So this is very, very simple, right? It looks very simple, guys, but when you come to apply this in the exam, it's very, very difficult, especially the recognition and the measurement part for assets, liability. Let us go to the recognition and derecognition. So for recognition, how do you recognize? You recognize items are recognized in the financial statements if they meet the definition of an element. Three things has to be there. First of all, they should meet the definition of an element. What are the definitions of an element? This table. Out of this table, are they meeting the definition of an asset, liability, income, or expense? Not equity, because equity is assets minus liabilities, simple, right? So mostly the focus is on assets or liability, whether it meets the definition of an asset or a liability. And it does not stop here. Just meeting the definition of an asset does not mean you're going to recognize it in the financial statements. Still, there is a condition. And recognition provides the relevant information. Relevant information is what? Fundamental characteristics. We have studied earlier, right? Just few minutes back, we saw that. Relevant and faithful representation. And faithfully represent. You see, so these three conditions, remember it, for recognition of asset or a liability, or income and expense also. In fact, all the 5 elements. Definition it has to meet, it has to be relevant, it has to be faithfully represent. These 3 characteristics has to be there. Then you recognize. Having only one of it, not suitable. Coming to derecognition, because the condition is and, it's not or. If it was or, okay. If one condition is satisfied, you recognize it. No, it's and. So always whenever you are applying conditions, you have to see whether and or. Coming to derecognition. Derecognition occurs when you lose the control of an asset or has no present obligation for the liability. How do you lose the control of the asset? Maybe you have sold the asset, right? That's the most common scenario, right? When you're selling an asset, you're losing the control of the asset. Control is going to the customer. So you have to derecognize from your financial statement, and customer is going to recognize it, whoever's having the control, and has no present obligation for the liability. Yes, maybe you have paid the debt already. You have paid the interest. Now no more liabilities there. Derecognize it. So accounting for derecognition should faithfully represent the changes in an equity's net assets as well as any assets or liabilities retained. People often forget that. Sometimes we don't completely sell it entirely. We retain portion of it. What happens? That retained portion you have to recognize. And only the ones that you have sold or transferred, you have to derecognize it. Because then it represents faithfully. So this involves what? Derecognizing any transferred, expired, consumed component, and you see and is there. When you are selling anything, what happens? There will be a gain or a loss. So that you have to recognize. Then and recognizing any retained component. So 3 things are there. Derecognize whatever you have sold, recognize a gain or loss, and recognize whatever you have retained. Simple. Coming to the measurement and the presentation and disclosure. Measurement. So element in the financial statements must be quantified. Now you are putting a value to that, what you have recognized. Definitely should be first recognized only. Then only we talk about measurement. If you don't recognize it only, measurement stage does not come. Something you have recognized it before, right? Whether assets, liability, income, expense, equity, anything. You have to measure it. Okay, so on this conceptual framework says there are 2 measurement bases. One is the current historical cost. The other one is the current value. So current value includes, it could be fair value, it could be value in use, it could be the current cost. Anything out of this 3. And mostly we have seen it's the fair value. For this we have a separate standard, IFRS 13, which we are going to cover later on when I actually touch IFRS 13. Okay. Then, so when selecting a measurement basis, also relevance is maximized if the following are considered. See, they always talk about relevance, faithful representation, relevance, faithful representation. These 2 are fundamental characteristics. They will always be talked about. Whether it is for recognition, whether it is for derecognition, whether it is for measurement, whether it is for presentation. Okay. So characteristics of the asset or liability. when you're selecting a measurement basis also, for example, for my non-current, for my motor car, or let's say for my plant and equipment, I'm using a historical cost or I'm using a fair value. How do you decide that? Because you have an option is there, you can use any of those two. Okay, so for that you have to see the relevance, which one out of this if I choose will increase the relevance of it, will make it more relevant. Current cost, sorry, current value or the historical cost. So for that you have to see the characteristics of that asset or liability. If that characteristics of that asset is such that the value increases, changes very frequently, then fair value is the better method, not the historical cost. If the value does not change so much and if the fair value is not so much different from the historical cost, then you can use historical cost. Then second thing that you have to see when selecting a measurement basis, this is when you have an option to select a measurement basis. When you're compulsorily told that you have to go by this method only, then this issue does not come. Then you don't have to see whether it will increase relevance or not. Then you don't have to see the characteristics of as an asset or a liability. Okay, only when you have an option. So not every standard has an option. Some standard has, for example, IAS 16 has that option. IAS 38 intangible asset also has that option. So how, second characteristics that you have to see is how asset or liability contributes to the future cash flow. That means whether, for example, when you are taking the impairment, how do you calculate recoverable amount? Whichever is lower, no? I'm sorry, whichever is higher, value in use or fair value less cost to sell. Because whatever we consider the best that contributes to the future cash flow, whether having that asset contributes to the future cash flow or selling that asset contributes to the future cash flow. So based on that, we are going to select a value. Fair value, less cost to sell, or current cost, sorry, the value in use. We use this in IAS 36 for impairment. Okay, so these are the two things. Presentation and disclosure. And now don't go and start doing this checking for every standard. It is already fixed that IAS 16 will follow this, leases will follow this, then intangible asset will follow this. It's already there. This you have to write about when a question comes on conceptual framework. You have to talk about those things. Okay, because sometimes conceptual framework does not come as a standalone question, not as a separate question. Sometimes it is embedded in your IFRS or IAS standard. Sometimes you have to make use of conceptual framework in your answer to better answer, right? To get more points. Because sometimes it's not enough that you cannot use the standard to answer. For example, your question was on IAS 16 measurement basis, whether it is appropriate to measure fair value or historical cost. The question was that. They didn't mention anything about conceptual framework. But indirectly you have to make use of it, because conceptual framework is the only place which talks about it when it comes to measurement choices. How are you going to decide on that? So there you need, even the question is about IAS 16 measurement, you have to talk about the conceptual framework. You understanding? So that's why this conceptual framework is the first lecture I have started, because this you need throughout all your standards. You have to link this with all the standards, because standards are built upon conceptual framework principles only. How do you think they are recognizing non-current asset, or they decide that they are not going to recognize or this measurement basis? How do they decide? From the conceptual framework they have taken it. So it's not two separate things. Don't study them in isolation. Conceptual framework is there and the standard. No. Presentation and disclosure. So it's like I can tell you that conceptual framework is like the mother. Okay, conceptual framework is a mother, and all the IFRS and IAS standards that you are seeing, they are the children. Okay, so these are the children of the conceptual framework. You understanding? So presentation and disclosure. How do you present? And when you have to disclose? And in what order? So statement of profit or loss is the primary source of information. When you have to understand what is the financial performance, where do we look for profit and loss? Statement of profit and loss. It is the primary source of information. Primary means the main. First we see there only, then only we have to say any other things, then we go to the other places. So income and expenses. So statement of profit and loss means we have to talk about income and expenses. because we have already talked about assets and liabilities. How do we measure? But income and expenses we don't have to measure, because income and expenses comes along with the asset and liability. For example, liability, let's say you have taken a loan, right? You have taken a loan, so on that loan you have to pay an interest, so that interest is an expense. So that interest comes along with that loan you have taken. In isolation you will not have expenses like that, or income. So income and expenses we don't have to measure. Neither equity we have to measure. Measurement is only for two things: assets and liability. Income and expenses automatically comes with that asset and liability, and equity is simply the difference between assets and liability. So income and expenses should be recognized in this statement, that means statement of profit and loss. Then we are coming to the OCI, other comprehensive income. See, I have told you, conceptual framework is the mother, it will include everything. What item will go to OCI, what is profit and loss, what will go to asset, how asset will be presented, what will go under asset, what will go under liability, everything will be in the conceptual framework only. So the board might require income or expense to be presented in another comprehensive income also sometimes. But if it results from what remeasuring an item to the current value, for example, you have measured something using a historical cost, let's say your property, plant and equipment, your non-current asset, you are valuing using a historical. Now you are changing, you are revaluing it to fair value. What happens? There's a change in value, right? From historical to fair value. So there's a change. That change is recognized in other comprehensive income, not in profit and loss account, because that because there's the nature is different. This, it could be an income, it could be an expense, depending on how the fair value is going. If it goes up, then it will be an income. If it goes down, right, it will be a gain. If it goes down, it will be a loss, right? But this gain or loss is not from the normal asset or liability that we have incurred. For example, if we have taken a loan, interest is an expense, so recorded in the statement of profit and loss. But this is due to remeasurement. It is not because we have taken an asset or we have incurred a liability. That's why we are having this gain or loss. This is a gain or loss on remeasurement. So that goes in other comprehensive income, not in the statement of profit and loss. So if this means profit or loss provides more relevant information, or or it's not an and, or more faithful representation is provided from an entity's purpose. So because sometimes the remeasurement part, remember, it's not always under other comprehensive income. Only if it means that presenting it under other comprehensive income, the gain or losses from the remeasurement means more relevant information or faithful representation, any one of this. If it's not relevant, if it means it's not more faithful representation, then record it simply in the profit and loss. Don't record it under the comprehensive income. Some standards are there which does not give you that choice. One good example is what? IAS 40, your investment, right? What does it say? Remeasurement will go to fair value. Sorry, the fair value movement. The gain or loss will go where? It will go to profit and loss account, not other comprehensive income. But under IAS 16, they say no. It goes under other comprehensive income, right? So you can see different standard have different things. Because investment property, they believe that presenting it under other comprehensive income is not relevant, and it's not more faithful representation. So they simply record it under profit and loss. But IAS 16 says no. They feel it's more relevant and faithful, and it will faithfully represent to present it separately from the profit and loss under other comprehensive income. So income and expenditure included in other comprehensive income should be reclassified to profit and loss. When doing so results in profit and loss, providing more relevant information. Please read the last para, because questions have come from this area, whether you have to reclassify to profit and loss or you should not. What do you think on that? That income and expenditure also that you are recognizing under other comprehensive income. Remember, sometimes in future you can bring it back to profit and loss account, but some income and expenses, some you cannot. Some it will always be in other comprehensive income only. You can never take it into profit and loss account. We have definitely gone through some standards there. We have seen one is IAS 19. One example is IAS 19, remeasurement of employee benefits. You cannot reclassify to profit and loss. some, for example, financial instruments and all, when you are reclassifying it, that you can reclassify to profit and loss account. Gain or losses relating to foreign exchange, that also you can reclassify to profit and loss. But you can reclassify if doing so will provide more relevant information. If you think that if you put it in a profit and loss, it will be more relevant information. So that's it, guys. We have completed conceptual framework successfully, and upcoming next is ethics. So see you in ethics. Until then, take care.